X 100%. Engineer your financial freedom.
Hey everyone, and welcome. So today we're going to tackle a topic that sounds super complicated, but is actually one of the most powerful and surprisingly simple tools every investor should have. It's portfolio rebalancing. Think of it as your secret weapon for making sure you stay on course with your financial goals. And I promise, by the time we're done here, you'll know exactly what it is and how to do it. But let me ask you something right off the bat. Is your investment portfolio riskier than you actually think it is? And I'm serious about this, because even if you started with the perfect plan, the market has this sneaky way of messing with your plan in the background without you even noticing. That perfectly balanced mix of investments you set up, well, it might look a whole lot different today. And that difference could mean you're taking on way more risk than you're comfortable with. So here's our game plan for today. First, we're going to talk about something I call silent drift. Then we'll dive into the real power of rebalancing, why it's such a big deal. After that, we'll figure out when to actually hit the reset button. Then, the main event, a simple 6-step guide on how to do it yourself. And to wrap it all up, we'll see how it all works in the real world with a practical example. Okay, let's get right into it with the main problem we're trying to solve, your portfolio's silent drift. Picture this. You create this fantastic investment plan, a great mix of stocks and bonds that perfectly matches your goals, your timeline, your comfort with risk. You kind of set it and forget it, right? But here's the thing. The market never stops moving. And because of that, your perfect plan slowly, quietly morphs into something totally different, something you never intended it to be. And that, my friends, is where rebalancing comes into play. So what is it really? Well, in the simplest terms, it's just the act of nudging your portfolio back to its original settings. I love the recipe analogy on the screen because it's spot on. Let's say your recipe calls for 60% stock and 40% bond mix. But then the stock market has an amazing year. All of a sudden, your mix has cooked into a 70-30 split. Whoa, that's not the recipe you started with. Rebalancing is just the chef's move. You sell off a little of the stocks that have grown too much, and you use that cash to buy more of the bonds that have fallen behind. It gets you right back to that perfect 60-40. See? It's about course correction, not trying to predict the future. Okay, so now that we know what it is, let's talk about why it's so powerful. And I'm not kidding when I say this simple habit is an absolute game changer. It's more than just tidying up your accounts. It might feel a little weird to sell your winners, but believe me, this one simple discipline is what separates really successful long-term investors from everyone else who just gets thrown around by the market's moods. It really all comes down to these 3 massive benefits. First, it controls your risk. When stocks have a great run, your portfolio gets more aggressive without you even realizing it. Rebalancing brings that risk level right back down to where you decided you were comfortable. Second, and this one is huge, it enforces discipline. It makes you automatically sell high and buy low. Because, let's be honest, our gut tells us to do the exact opposite. We want to chase the hot stocks and sell things when they're down. Rebalancing takes the emotion out of it and automates the smartest thing you can do in investing. And finally, it maintains your strategy. Think of it like a rudder on a ship, making these small, consistent adjustments to keep you pointed directly at your financial destination. So we get it, it's important, but when do you actually do it? This is a great question. You can't just do it on a whim. You need a system, a clear trigger that tells you it's time. This is what keeps it mechanical and unemotional. And there are basically 2 main ways to go about this. One's based on the calendar, and the other is based on a specific trigger. All right, so let's break these 2 down. On one hand, you have the time-based method. This is the easiest to follow. You just pick a date on the calendar, maybe your birthday or the first day of the year, and that's your rebalancing day. It's simple, it's systematic, you can't forget it. The only catch is you might end up rebalancing when you don't really need to, or the market could take a huge swing right after your date, and you're stuck out of balance for another whole year. Then, on the other hand, you have the threshold-based method. With this one, you only act when one part of your portfolio drifts too far from your target, say by 5%. This is way more efficient because you only make a move when it's actually needed. The trade-off? You do have to check in on your portfolio a bit more often to see if you've crossed that line. Honestly, a lot of people use a mix of both. They'll check on a set schedule, like every quarter, but only pull the trigger if something is off by that 5%. Okay, this is the moment you've probably been waiting for. How do you actually do this? I know it can sound a bit intimidating, but trust me, it's just a simple checklist. So let's walk through the 6 steps that will put you in the driver's seat. All right, let's walk through this step by step. Step 1, define your target. You've got to know where you're going. Write it down. 60% stocks, 40% bonds. Got it? Step 2. Calculate current values. Easy enough. Just log into your accounts and see what everything is worth today. Step 3. Identify the drift. This is just a little bit of math. Figure out the new percentages. Are you still 60-40, or have you drifted to, say, 65-35? Now, step 4 is where you have a choice. Choose your method. You can either sell the stuff that's overgrown and use that money to buy the stuff that's lagging, or if you're adding new money to your account, you can just put that new cash into the underweight part of your portfolio until it's back in balance. That second way is often better for taxes since you're not selling anything. Step 5 is simple. Execute the trades. Just place the buy and sell orders you decided on. And finally, step 6, review and monitor. A few days later, log back in and just double check. Is everything back to 60-40? Perfect. You're done. That's the whole loop. Okay, all this theory is great, but let's make it real. We're going to follow a fictional investor, we'll call her Alex, and we're going to see how rebalancing actually works through 2 totally different years. One great year and one not so great year. This is where we see the magic happen. Okay, so let's meet our investor, Alex. She's starting out with a portfolio worth $100,000. She's decided on a classic 60-40 target. That means she wants $60,000 in stocks and $40,000 in bonds. This is her starting point, her recipe. All right, first up, scenario 1. The stock market is on fire. It returns a massive 22% for the year. Bonds do their thing, returning a steady 4%. This is the kind of year that makes every investor feel like a genius, right? But it's also exactly the kind of year where that silent drift can really sneak up on you. So let's crunch the numbers and see what happened. That 60 grand she had in stocks, it shot up by 22%. So now it's worth over $73,000. Her bonds grew a little to about $41,000. So her total portfolio is now worth almost $115,000. Awesome. But wait, look at the percentages. Stocks now make up nearly 64% of her portfolio, and bonds are down to about 36%. Without doing anything, her portfolio has secretly gotten riskier than she signed up for. So what's the move here? A disciplined investor like Alex rebalances. She needs to sell about $4,300 worth of stocks, the very thing that did so well, and she takes that money and buys more bonds. This right here is the textbook definition of selling high. She's locking in some of those profits, and most importantly, pulling her risk level right back to her 60-40 comfort zone. Okay, now for the flip side, scenario 2. Let's imagine a tough year where the stock market drops 15%. This is the kind of year that tests your nerve. But as often happens, the safer bonds in her portfolio actually did okay, gaining 8%. This situation is where rebalancing proves its worth, but it's also where it becomes really, really hard to do emotionally. So what does the damage look like? Her $60,000 in stocks fell to just $51,000. Ouch. But her bonds grew to over $43,000. So her total portfolio is down, but not as much as the stock market. But look at the allocation. Stocks are now only 54% of her portfolio, and bonds have ballooned to almost 46%. So now her portfolio is actually too safe, right when stocks are basically on a clearance sale. And this is the move that takes real guts. To get back to 60-40, Alex needs to sell over $5,000 of her safe bonds, the one part of her portfolio that's working, and use that money to buy more stocks, the very asset that's been causing all the pain. I mean, everything in your body is screaming no. Don't buy the thing that's losing money. But the system, the discipline, says this is exactly what you have to do. You're systematically buying low. You're buying stocks at a discount, setting yourself up for a much bigger rebound when the market eventually turns around. That is the very core of disciplined investing. So I want to leave you with this idea. Rebalancing is the act of being the calm, deliberate captain of your financial ship, making small course corrections to ensure you reach your destination safely. It's not about being a psychic or a market genius. It's about having a plan and having the discipline to stick with that plan no matter what. It is the boring, unglamorous, but incredibly effective work that builds real long-term wealth. It's not about predicting the future. It's about having a system, a set of rules that keeps you on track no matter what the market throws at you. And now you have one.